looking at a German advertising company called Ströer, or Ströer, if you're going to anglicize it. And this is a company that had been a billboard, out-of-home advertising company until 2013, when it announced this digital strategy. And since then, it's just bought a lot of different businesses, really a patchwork in the online and digital industries.
Yeah, no, I took a look quickly on their website because I just found out this myself. And it appears that their rather dramatic growth, I mean, revenue growth, profit growth, earnings per share growth, is 100% attributable to digital. It's basically additional of digital.
Well, you know, it's interesting because one of the things that we point out is the way they calculate organic growth, we can't get the numbers to tie. So, for example, they announced in 2014 that the organic growth in digital was 34%. Using their methodologies, their numbers, we get 2.2%.
And that's because of acquisitions, basically? That's why their numbers come out so high, rather than organic growth?
Well, in 2014, they changed the formula in 2015 for calculating organic growth. So in 2015, they began including organic growth from acquisitions, which is very counterintuitive. But again, when we calculate these numbers, we use their formula and their numbers, and it just doesn't add or come even close to adding.
You know what, I want to say, obviously we couldn't go to the company in advance to ask them, but now we are going out to the company to ask what their response is. But my question on specific organic growth is, who cares? In the sense that their earnings per share look like they're going up, so it doesn't appear to be dilutive in their acquisitions. If they're making good acquisitions and adding to their earnings per share, why does it matter whether it's organic or not?
Well, the question is, how do we know whether they're making good acquisitions? And what are they paying for these acquisitions? I mean, they've paid over 100 million euro in cash in the past few years, and they've increased the share count by about a third. So there is a lot of dilution there. Now, what's kind of falling to the bottom line, you know, it's not really clear the quality of that. I mean, we have a lot of concerns about the accounting. For example, we think that there are certain things that they're putting on the balance sheet that really are better or should be running through the P&L and decreasing EBITDA. So we think that there's really a lot here underneath the surface.
But I want to be precise about this. This is a publicly traded company. Mm-hmm. These are publicly reported numbers. Do you suspect or do you believe that they're misreporting their numbers? I mean, and wouldn't that be a securities violation? Wouldn't it be an accounting rules violation?
Well, look, it's not my place to judge whether there are violations or not. There are certainly a lot of questions that we have about these numbers, and we did catch what we believe is their auditor making a clear error in the cash flow statement. So
a material error? How big was it?
Well, it is actually an important error. It has to do with the borrowings. And if you look at the year-end cash flow statement, it doesn't look like the company borrows at all. But when you look at it intra-quarter, they actually are drawing down real amounts of money intra-quarter, which indicates that the cash flow of the business isn't necessarily that consistent or maybe that strong. But again, when the auditor prepared it or let them prepare it showing zero borrowings at the end of the year, in our opinion, that is complete misapplication of international accounting standards, and it's very misleading to investors.
So you are a researcher at base. That's what you do, right?
Yes.
As you say, you come up with about a 2.5% growth rate, something like that?
Yeah, I mean,
as opposed to like the 14% they're reporting. If you do the pro formas, what does that mean in terms of overvaluation right now of the capital of Ströer?
Substantial, because I mean, this company has, especially for Europe, a real premium multiple, and that's because of this blue sky story, where the market believes that they're really good at executing this digital strategy, and almost everything they buy turns to gold. And when we're looking at the numbers, I mean, we see that is definitely not the case. So if you have a company that's just kind of running around and, possibly willy-nilly, throwing money at, acquiring companies, really, does that get a premium multiple? I don't think so.
So Matt wanted to jump in here.
Yeah, I was looking, Carson, at the stock here, and it's amazing that, assumedly, your short call can drive it down just 25% in about a half hour. I see that it starts falling at 644, 645. So how do you publish this call, and how does the market get a hold of that information?
Well, we post the research on our website, and so I think it went live around then. To be honest, there's always this technical issue when we try to upload the report. Usually doesn't take right away. I mean, it's the Murphy's Law thing, so we can never pinpoint exactly when we get the report online, but we wanted it to coincide with my coming in studio and talking with you guys about it.
So it's down 25% now. It's lost a quarter of its value in just 30 minutes time.
So Carson, you, as we said in the introduction, you've been at this for a while now, and you had some very notable successes. All right, I mean, Sino-Forest was a big success for you. There have been other things that haven't worked quite so well. Mark and Towers, Casino. I think the jury's still out on. In your experience, because you are experienced, when do you win and when do you lose? What have you learned about when this is successful and when it falls short?
Interesting. I mean, that's actually the answer to that is, is pretty lengthy. With American Tower.